Bonjour tout le monde. Bienvenue à la Banque de Canada. Good morning, everyone. Welcome to the Bank of Canada and this morning's press conference about today's Financial Stability Report. Le gouverneur Macklem et la première sous-gouverneur Rogers vont partager leur déclaration préliminaire. Après, nous allons tourner à vos questions. Governor Macklem and Senior Deputy Governor Rogers will deliver their opening statement, and after that, we will be happy to take your questions for about a half an hour. Alors, la parole est à vous.
Thank you, Paul, and good morning. Senior Deputy Governor Carolyn Rogers and I are very pleased to be here to discuss the Bank of Canada's Financial Stability Report with you this morning. Each year, the bank assesses the stability of Canada's financial system and highlights risks that could threaten that stability. While some risks have diminished, the current trade environment has pushed risks higher overall. But let us look back for a minute before we look ahead. The country's financial system has faced unprecedented shocks in recent years, and it has proven resilient. Households, businesses, banks, and other financial institutions weathered the upheaval of the pandemic and the sharp rise in inflation and interest rates that followed. It was a difficult period for many Canadians, and pockets of stress remain. But proactive steps taken by households and businesses, together with substantially lower interest rates, put the system on a more resilient footing heading into 2025. Now the Canadian economy and financial system face a new threat. U.S. trade policy has taken a dramatic protectionist shift. Tariffs and uncertainty have sharply reduced prospects for global economic growth, and financial markets have been rocked by chaotic policy announcements and reversals. A long-lasting trade war poses the greatest threat to the Canadian economy. It also increases risks to financial stability. There are two key concerns. In the near term, the unpredictability of U.S. trade policy could cause further market volatility and strains on liquidity. In an extreme case, market volatility could turn into market dysfunction. In the medium term, a prolonged global trade war would have severe economic consequences. It would reduce growth and increase unemployment. This could, in turn, have important ramifications for the financial system. With debt still at high levels, some households and businesses may be unable to keep up with payments. If loan losses occur on a large enough scale, banks could cut back on lending in response. This would exacerbate the economic downturn and put more pressure on businesses and households. Une longue guerre commerciale est la plus grande menace pour l'économie canadienne. Elle accroît aussi les risques pour la stabilité financière. Il y a deux grandes préoccupations. À court terme, la politique commerciale américaine imprévisible pourrait accroître la volatilité des marchés et causer des problèmes de liquidité. Dans des cas extrêmes, la volatilité des marchés pourrait perturber leur fonctionnement. À moyen terme, une guerre commerciale mondiale prolongée aurait de graves conséquences économiques. Elle ferait diminuer la croissance et monter le chômage, ce qui pourrait avoir des répercussions importantes sur notre système financier. Comme l'endettement est encore élevé, certains ménages et entreprises pourraient avoir de la difficulté à faire leur versement. S'il y a beaucoup de pertes sur prêt, les banques pourraient accorder moins de financement. Ce ferait ralentir encore plus l'économie et causerait plus de pression sur les entreprises et les ménages. What we are evaluating in this report are the indications of stress in the overall financial system. There are many uncertainties. We still don't know what tariffs will remain, whether they'll be reduced or escalated, and how long all of this will last. That makes it particularly difficult to anticipate the risks to the financial system. In our April Monetary Policy Report, we presented two illustrative scenarios to show how a trade war could affect the economy. In the FSR, we focused on the more severe of those scenarios to explore how the trade war could affect different parts of the financial system. To be clear, our analysis is not a projection. It's an assessment of vulnerabilities, pockets of existing or potential stress that could spread across the financial system. So let me now turn to the Senior Deputy Governor to outline these vulnerabilities and how they affect the four key sectors of our financial system: households, businesses, banks, and institutions known as non-bank financial intermediaries. This is a broad category including finance companies, pension funds, insurance companies, and fund managers. Carolyn.
Thank you, Governor. I'll start with households. Total debt relative to disposable income is lower than it was a year ago, but still high by historical standards. Despite lower interest rates, signs of financial stress have risen over the past 12 months, particularly in households without a mortgage. For example, the share of these households that are behind on credit card or auto loan payments has continued to go up. Among households with a mortgage, about 60% are facing renewal this year or next. Most of those renewing will see their payments rise because they took out their mortgage during the pandemic when rates were at historic lows. But the average increase in payment will be smaller than we expected a year ago. Still, if a large shock causes job losses, it'll be harder for some households to keep up with their debt payments. A prolonged trade war may be that shock. It would cause demand for Canadian exports to fall. It would disrupt supply chains, threatening jobs and incomes. Workers in trade-dependent industries could find it particularly difficult to continue managing their debt. A prolonged trade war would also matter for businesses. Most Canadian businesses have managed to adjust to past interest rate increases, and the surge in small business insolvencies last year proved to be temporary. But businesses in trade-related sectors, especially those with high debt, low profitability or cash reserves, could also fall behind on debt payments. A strength in our financial system is that Canadian banks are well positioned to absorb higher credit losses. Banks have increased their capital buffers in recent years, and more recently they've also increased their provisions for credit losses, and these both bolster their resilience. Liquidity levels remain high, and access to funding for banks is also good. But if credit losses occur on a large enough scale, banks could cut back on lending in response. Struggling households and businesses would then have less access to credit to get through tough times. This cycle could exacerbate the economic downturn. In the non-bank financial sector, the growing presence of hedge funds in the market for Government of Canada bonds raises some concerns. Government bond markets are the foundation of the financial system, and they need to function smoothly for all other markets to work well. The increased activity by hedge funds has helped absorb increased issuance of government debt, keeping yields lower and liquidity higher. But hedge funds have also taken on increasingly large amounts of leverage to fund their purchase of government bonds. And this makes them more likely to pull back from these crucial markets in periods of stress, introducing added volatility. The recent gyrations in the U.S. Treasury market clearly illustrated this risk. If the trade war causes a larger spike in volatility than we've seen so far, leveraged hedge funds might rush to sell their holdings. That could strain liquidity across core markets, increasing stress throughout the financial system. Moreover, the growing connection between banks and non-bank financial institutions could make it easier for stress to spread. Against that backdrop of increased market volatility, and given their importance in the government bond markets, hedge funds need to make sure that they're prepared to respond to sudden liquidity needs without disrupting broader market functioning. It's time to wrap up. Notre système financier est solide. Malgré les dettes élevées et la pandémie, les Canadiens ont surmonté la hausse rapide des taux. C'était un test majeur. Le système a montré qu'il est une source de stabilité, mais on doit rester attentif. Il reste des faiblesses et un autre test s'annonce. The Canadian system is resilient. Despite high indebtedness and the economic turbulence of the pandemic, households, businesses, and banks weathered a rapid increase in interest rates. That was a big test, and the system proved to be a source of stability. But we must all remain vigilant. Vulnerabilities remain, and there is another test on the horizon. By identifying vulnerabilities, we can help the financial system prepare for future stress. We're watching developments closely and remain in regular contact with financial system participants and with other authorities in Canada and globally. A stable, resilient financial system that absorbs shocks rather than amplifying them benefits every Canadian. And with that, the Governor and I would be pleased to take your questions.
Okay, thank you both. We will go to questions now, starting with the reporters here in the room in Ottawa, and after which we'll go to those who have joined remotely. Today we're going to do one question and, if desired, one quick follow-up per outlet, please. If I forget to do so, please state your name and affiliation. Avant de poser votre question, veuillez vous identifier si j'ai oublié de le faire. Et bien sûr, libre à vous de poser vos questions dans la langue officielle de votre choix. So let's start here in Ottawa, and I'm going to call on Eric Bloomberg from Eric Bloomberg. You know, that's twice I've done that today. Eric Hertzberg from Bloomberg News, please.
Good morning. Firstly, how much responsibility does the Bank of Canada ascribe to itself when it comes to the rise in household balance sheet vulnerabilities in the last decades?
Look, I think the purpose of the report is to highlight where the vulnerabilities are. And why do we do that? Well, we do that to help the financial system prepared for worst case outcomes. So, I mean, coming to households, household indebtedness has risen now, going back, a large number of years. I'd have to actually go back and put a number on it. But we've been expressing concern about rising household indebtedness for many years now. And that's happened against the background of low interest rates. It's happened against the background of high interest rates. So I think it's a broader issue than monetary policy. What we saw last year, actually, is the combination of a strong income growth and also lower interest rates. You actually saw households' debt relative to income start to move down. I think the ratio went from the high 70s to the low 170s, not 70s, sorry, the high 170s to the low 170s. So it was moving in the right direction. And when you combine that with lower interest rates, our assessment is that for most households, that is making servicing their debt more manageable. The big message in this report is we now face a new threat. The trade war poses new risks. So even if things were moving in the right direction, it's a really good time to get prepared for possible turbulence ahead.
And just to follow up on the new threat, how do you view the U.S. president's threats and pressure on Powell and the Fed from a financial stability perspective? Is this a risk?
Well, look, the independence of the central bank is sacrosanct. I mean, it is a key element of central banks around the world. There's a reason you have independent central banks, and the record of independent central banks with clear mandates, in our case, an inflation target, has served Canadians very well, and similarly in other countries. So I don't think you want to threaten the independence of the central bank.
Okay, we're going to go to Greg Quinn from Market News now, please.
Good morning. Not sure who wants to answer this one. The report had a discussion around hedge funds and their increasing activities in Canada's government debt markets. I just wondered about the supply of government debt. We've had large deficits through the pandemic. I mean, isn't that policy a reason why hedge funds may be coming into Canada? Maybe, in other words, haven't we kind of invited some of these concerns?
Well, this is actually a pretty global phenomenon. In fact, when I was in Washington a couple of weeks ago around the IMF meetings, it was an opportunity to compare notes with other countries. And you're seeing this actually globally. More generally, non-bank financial institutions have been growing more rapidly than the banking sector for, a good decade now. And part of that is the growth of hedge funds. And there are some benefits. Hedge funds are a new investor class for government bonds, and in Canada, as you mentioned, like everywhere else, government debt levels have been higher. Hedge funds are they're new. They're buying bonds. They're adding liquidity to the market. So the issue really is that hedge funds tend to buy government bonds using a lot of leverage, and when you're a leveraged investor, if you see a rapid change in market conditions, you may need to exit your positions. You may need to pull back, and so, while the entry of hedge funds is bringing some benefits, it's also posing some new risks, and we highlighted this actually in the last FSR. We're highlighting it again today, and really the message to the hedge fund community is. We're in a more turbulent period. Make sure you manage your liquidity, make sure you're risk managing your positions so that you can handle higher turbulence.
Senior Deputy Rogers, you became famous in the political class for a break the glass moment on Canadian productivity. We now have an existential threat to our economy from the U.S., yet I still see premiers talking about bilateral free trade deals, whether they can even move wine from British Columbia to Alberta. It doesn't seem like, based on that, I could say it doesn't seem like we're really meeting the risk. Is the glass broken? Would it not be better if provinces could trade in the same terms internally as we're asking the United States to trade with us?
It would, and I think the conversation has started. We need that conversation to turn into policy decisions. That takes time, though. Interprovincial trade was only one of the things we talked about when we talked about productivity. So it's good to see some movement on that. We're also hearing calls for more business investment, more training, better use of AI, all of those things. So I think the conversation has shifted. We do need to see that to continue. We need the momentum to continue, to see some policy changes, but I'm optimistic.
All right, next up, I'm going to go to Jordan Gowling from the Financial Post, please.
Good morning. Governor, you highlighted in your opening remarks that Canada's financial system has weathered unprecedented shocks in recent years. You talked about the pandemic, the inflation crisis. Are you confident it can weather this tariff shock in the same way as it did with previous shocks?
Well, we both might want to take this question. I'll just say a couple words coming into it. The bank's capital cushions are higher. They've got pretty high levels of what we call SETI 1 capital, which is sort of the best loss-bearing capital. They've also increased their provisions. Now, provisions are for the credit losses that you can predict might happen. Then for the things you really can't anticipate, you've got capital. And both of those things are at very solid, good levels. So, yes, we are confident that the banking sector is well positioned to withstand a severe shock, and you see that. For example, the stress test that we report that the IMF did with us as part of the FSAP, the Financial Sector Assessment Program, the IMF runs every 4 years with their members. You can see it. I mean, it's a very severe scenario. It has a big impact on banks. Capital levels come down, but the capital levels are able to absorb the shock. The risk, though, that we are concerned about in a very extreme situation, banks might, in a very extreme situation where they are facing large credit losses, banks may be in a situation where they need to pull back on lending to protect their their capital. And if that happens, the banking sector moves from being a shock absorber to a shock amplifier. And that's what you don't want to happen. That makes a bad situation worse. But I think we are confident the banks are coming into this in a good place. And, the message here is this is a time for vigilance. I don't know if you want to.
I mean, the only thing I'd add to that is that you always have to be careful not to fall into the trap of preparing for the last crisis. The thing about a crisis, what makes it a crisis is you didn't expect whatever happened to happen, right? So this is one of the things we do in the FSR is we think of what could possibly go wrong. We devise these stress tests. They're not forecasts. They're actually designed to be very sort of tail risk scenarios. And we basically run a model to see what do we think the banks would do in that situation and how would they fare. So, the ones that we present in the FSR this year are pretty extreme scenarios. So that's the thing that gives us confidence that the banks are well positioned to be that shock absorber. But you have to stay vigilant. And the banks themselves run these tests too. So these are our stress tests. They run their own stress tests. So this is how they're thinking too. What could go wrong, and are we prepared for that?
The report paints a pretty bleak picture for mortgage arrears in a worst-case global trade war scenario, making them comparable to the 2008 financial crisis. How long do tariffs have to remain in place for this scenario to turn into a reality?
Well, again, it's important to remind you that this isn't a forecast. So really, as I said, what we've done here is we've taken one illustrative scenario out of the NPR, and then we've also taken the scenario out of the FSAP stress test and modeled used them as channels through which the financial sector would sort of travel and looked at what could happen. But it isn't a forecast. We can't tell you if X months happen, then we get to X position in arrears. It's not that detailed scenario.
It's a pretty extreme scenario. I mean, scenario 2, the IMF FSOP,
It's longer than
they're extreme scenarios. They imply a pretty dramatic escalation of the trade war and something that lasts for a long time. I mean, to put it in simple terms, when you're doing the FSR, you put your gloomy hat on. You get gloomy, you think about, okay, what could go wrong? And then you ask, how well prepared are we? How do we get better prepared?
And you can look at Table 1A, Jordan, and you'll sort of see the scenario mapped against previous episodes of stress and sort of how extreme things would need to be. Yeah.
All right, let's go to Promit Mukherjee from Thomson Reuters, please.
Good morning, Governor. In the light of the meeting between Prime Minister Carney and President Trump, what do you think are the chances of the trade war not being protracted and prolonged?
Well, look, I think it was important that the Prime Minister and the President of the United States connect. I think it's important that they understand each other's positions, and it's important that the lines of communication were open. That was accomplished. But there's clearly a long way to go. I think what we've seen from U.S. trade policy is that it can, we have seen a series of significant tariffs put on with subsequent reversals. I think what you got to take away from that is it's pretty hard to predict. I mean, on the one hand, what we're all hearing from the White House is they want to do deals. They're sitting down with countries. They want to negotiate deals to bring tariffs back down. On the other hand, there are threats of new tariffs, pharmaceuticals, semiconductors. We'll see. We'll see. So I'm not going to try to handicap which way this is going to go. I think getting back to the April NPR, that's why we use scenarios. Let's hope we move more towards scenario 1 or something even better. But particularly in the context of the FSR, we focus on scenario 2 because we want to make sure that if things are really bad, the financial system is resilient and can help Canadians, help business get through what would be a very bad period.
In case there is, in case we manage to sign a deal with Mr. Trump and the tariffs are removed, what are the country-specific risks do you think are still there for the financial stability of the system?
Well, look, first of all, I would say that would remove what we think is the biggest risk, the most immediate risk, and that would be extremely positive development, both for the economy and for the financial system. I mean, in terms of some of the risks that would remain, we've talked about the growth of non-bank financial institutions, including hedge funds, in our markets, the fact that they take more leverage. In the last FSR, we highlighted the growth of the bond futures basis trade. Those things all predated, while, as I mentioned, there are certainly benefits, they do pose some risks. The trade war is a potential trigger, but that vulnerability is still there. Household indebtedness is also still elevated. Good news is it came down through last year. It's moving in the right direction. But after many years of going up, 1 year of going down doesn't remove that vulnerability.
Okay, I'm going to go to Mackenzie Gray from Global, please.
Hi there. I know the tariffs move around and I know things change a lot, but in the current context that we find ourselves today with the tariffs that are on Canada, if they were to stay in place for an extended period of time, would that lead to the severe economic consequences that you referenced in the report?
We're not here to give a forecast, but what I can say is that the current tariffs are significant, but the scenario 2 that we focus on in the FSR would be a significant escalation relative to where we are today, not only for Canada, but for other countries around the world. And that would imply a much bigger effect on the global economy. Canada's an open economy. We trade with the global economy. If the global economy slows sharply, that will spill back into Canada. And they're also more serious for Canada. So scenario 2, the current situation is problematic really for 2 reasons. 1, the tariffs themselves. 2, the uncertainty. Where are we going from here? And it's very hard for businesses to plan their investment decisions, their hiring decisions, if they don't know the path forward. So, it is already having a material effect on the economy, but scenario 2 would be a lot worse than where we are now.
You just mentioned it there, that the uncertainty and even the specter of tariffs hanging over the Canadian economy impacted investment. If the tariffs ended tomorrow, would there be significant scarring in the Canadian economy that would last going forward? And on that point as well, in the report you mentioned prolonged trade war going forward. Can you just put a timeline on what you estimate prolonged would need to be for these impacts to happen?
Well, look, on the second one, these are illustrative scenarios. Prolonged means, it's not a year, it's at least a few years. So I'm not going to put a precise number on it, but it's several years. With respect to your first question, if the tariffs are removed, sorry.
Just the impact you mentioned in the previous answer, just how much, if the tariffs ended tomorrow.
Oh, how much scarring will there be?
The scarring.
That's a very good question. I expect there will be some permanent impacts. It does feel like trust has been broken to a certain degree. And, to be frank, there's some things Canada should have been doing anyways. We should have been developing broader markets than the U.S. We should have been strengthening our internal connectivity, internal trade, internal transportation. I do think there will be some permanent effects because I think, to some degree, trust has been broken to some degree, and we're not going to get that all back right away.
Finally in the room, Paul Vieira from Wall Street Journal.
Better take that.
Good morning. Outside of moral suasion, what tools are available to persuade hedge funds to heed your message on liquidity?
I mean, one of the primary tools is the report itself and bringing some transparency to the risks that we see. We talk to hedge funds and other asset managers on a frequent basis. This isn't the only time we're talking to them about their risk strategies and stuff. So, I mean, one of the benefits of the Financial Stability Report is we help other sectors of the financial sector understand where the vulnerabilities are as we see them and what the contingency planning is. Because what you don't want to have happen is whatever risk strategy one sector has to manage volatility depends on another sector doing something or not doing something, and it turns out we're all storming for the doors at the same time. We're all looking for liquidity at the same time. So just bringing the transparency to the vulnerabilities, helping each sector understand what the other sector is doing and what their risk strategies are, is a tool in and of itself. We're not a regulatory body. We work closely with other regulatory bodies across both domestically and internationally. But it's not necessarily our role to bring regulation, and quite honestly, not every problem requires regulation to fix it. Sometimes the transparency is enough.
Okay, all good there. That's it for Ottawa. We're going to go to the reporters who have joined remotely. I'll just remind you folks on the line, please come off mute only to ask a question, then go back on mute as soon as you finish. That way everyone can hear the response. And I'm going to start with Ian Bickus from Canadian Press. Please go ahead, Ian.
Thanks for squeezing in my questions. We did just have an election in Canada, and I know you don't want to weigh on what the government should do, but can you say kind of what areas of policy or government action you'll be most closely watching that might affect financial stability going forward?
Well, it's a pretty wide open question. I mean, the regulation, so the oversight of the financial system, or at least the banking system, the federally regulated banks, is provided by the Office of the Superintendent of Financial Institutions. We've got the CDIC, the Deposit Insurance Corporation, which protects depositors. You've got FCAC, the consumer agency that protects consumers. You know, the banks, and then you've got the finance department, the government, that creates the legislative framework that everybody operates in. So we do work together. The bank's role is very much assessing the vulnerabilities and using our expertise from a kind of a macro financial perspective. We're not focused on individual entities the way the Office of the Superintendent of Financial Institutions would be. We're really looking at the system as a whole, the interactions, and how one vulnerability could spill over to others. So, this new government is just getting formed. The cabinet hasn't even been named. Let's see what their priorities are for the financial system.
Maybe one thing I'll maybe elaborate on a bit. The bank does have quite a new mandate to regulate the payment space. And one thing we are hearing in the US right now is a desire to increase the role that cryptocurrencies play in the financial sector. So right now, both in the US and in Canada, cryptocurrencies are largely, they're regulated as a security. They're really used to sort of speculate. If cryptocurrencies become a form of payment, then consumers will need to rely on them, on their value remaining stable. So there's lots of discussion about stable coins becoming a more common payment form. If that happens, certainly we would have we would need to introduce new legislation in Canada to ensure that we have the proper protections in place to use cryptocurrencies as a form of payment or stable coins as a form of payment.
Thank you. And then just following up, you did mention the report that the renewal risk for mortgages has come down, or the pressure has come down. How much does that reduce the need to kind of reduce rates, or how much is that going to affect your decision on rate decisions, the kind of mortgage renewal pressures that have been a big concern in the past?
Well, I mean, we look at many things when we make rate decisions. We don't make them purely on the mortgage market. It is one of the things we always consider. Really, again, from a financial stability perspective, we were watching carefully. We knew that the interest rate response to inflation was putting pressure on households, and particularly on mortgages. We've watched that carefully. As rates have come down and other things such as income have come up, that pressure has eased. But it doesn't. It's not. It's not a variable on which an interest rate decision turns.
Okay, let's go to Mark Rendell from the Globe and Mail, please.
Thanks for taking the question. Governor, you mentioned earlier in response to an earlier question, you're not trying to handicap whether we're heading towards scenario 1 or scenario 2. But there have been a number of developments since the rate decision and since the NPR, whether that is, hints from the U.S. that they're talking to China, a deal today with the U.K. apparently being announced, what seems like a pretty positive meeting between the Prime Minister and Mr. Trump. Are we closer to scenario 1 than scenario 2 than we were in the NPR? And how have those probabilities shifted since the NPR?
Well, Mark, where I'd start is this continues to be a moving target, and that's why we had scenarios, and I think until we have a clearer sense of direction, I think those scenarios are useful. Let's hope, particularly by the time we get to the July monetary policy report, there is a clearer sense of direction, and we can at least narrow the scenarios or possibly move more to a central scenario. But we're not there yet. Look, it's pretty, it continues to move around. And so I think you have to be careful about, getting, too focused on exactly where you are, what scenario. I mean, I will give you this. Yes, since we did the last monetary policy report, since the April monetary policy report, there have been some positive developments. Mm-hmm. And yes, I think that, what we said is we're somewhere between 1 and 2. Yes, so we've moved a little closer to 1. But, it is still pretty early days. We're going to, yes, I have, the UK deal is about to get announced. There are potentially a whole other series of deals. Canada needs to sit down with the United States and chart a path forward. So I think we have to be prepared for the fact that let's hope we keep moving in the right direction, but we have to be prepared for the fact that some other things, there could be some setbacks, there could be some new volatility, and that's why we're having this discussion here today. We want to make sure that there is a level of vigilance, that there isn't overconfidence that everything is going to work out, and that the financial system is prepared for turbulence. Let's hope it doesn't happen, but let's make sure we're prepared if it does.
On the question of turbulence, I'm wondering, when you guys looked at the period in early April after Liberation Day, when there was a big sell-off in the Treasury market in US dollars, I'm wondering, can you guys explore when you were looking behind the curtain into different aspects of the financial system we can't necessarily see, what was principally happening that was causing those big moves in Treasury markets and the dollar? And you also, kind of continuation of that, you also highlight in the report, the risk that the kind of safe haven status of the U.S. assets and the U.S. dollar may be shifting over time. I'm wondering how big of a risk is that? Is that a tail risk? Is that something that you're taking more seriously now? Thanks.
Okay, well, for a follow-up, you packed a lot in there, Mark. But let me highlight a couple of things. First of all, it is important to distinguish between extreme volatility and market dysfunction. And we did see bouts of extreme volatility following the April 2nd announcement. But markets continued to function. We did not see dysfunction. Yes, liquidity was scarcer, it was more expensive, but if you paid up for it, it was there. Buyers were coming in, markets continued to function. Second point, as you indicated, we did see some unusual correlations at these moments of extreme market volatility. In particular, equities and bonds both fell at the same time, and the US dollar depreciated against a background of a broader flight to safety. So, yes, there has been considerable discussion around, okay, what was going on in the market at that time. And, there is a certain, particularly in the private finance part of the market, there is some degree of opacity. So it's hard to be definitive. And in fact, this has been one of the priorities the FSB, the Financial Stability Board, has globally, is to try to get more transparency into private finance. But certainly what it looks like is that hedge funds, which, as I mentioned, have been taking a bigger presence in U.S. Treasury market as well as Government of Canada market, they are leveraged, and it does appear that they were exiting some positions, getting cash, so that created additional selling at that point, and that put downward pressure on prices. So that did create a period of unusual correlations. Since then, market volatility has gone down. The correlations are back to more normal types of correlations. With respect to this issue of the U.S. dollar as the global reserve currency, yes, the performance of the U.S. dollar in moments of volatility is one part of its role as the global reserve currency, but there are many other dimensions, many other reasons why the US dollar is the global reserve currency. And I think what you're hearing when you talk to global investors was, okay, well, even if the US dollar is performing a little differently, if I'm not in US dollars, I got to be in something else, and that could perform even more differently. So, we've seen a lot of money come into the United States in the last number of years. We may see some diversification out of the U.S. dollar. I don't think that would be too surprising, but that's very different from the U.S. dollar losing its status as global reserve currency, and I think it's way too early to speculate on that.
Okay, and that concludes today's press conference. So thank you, Governor Macklem, Senior Deputy Governor Rogers, and thanks all of you for joining us. See you next time.
Thank you.